Right now, Bitcoin's spot price is hovering near a seemingly stable $63,950. But just beneath that calm surface, millions of dollars in notional volume are being violently obliterated. This is a liquidation heat map, a map of pain felt by over-leveraged traders. We're seeing a massive battleground between $61,000 and $65,000, with these dense yellow and green bands acting as a ceiling that traps anyone betting too heavily on a breakout. While the market is distracted by the blood in the water on the derivative exchanges, the underlying network is preparing for a massive, counterintuitive recalibration. If we look past the price, the network data reveals a glaring anomaly, an impending 10.7% plunge in mining difficulty. To stay ahead of the deep layer shifts that the broader market is ignoring, make sure you're subscribed to the channel. Understanding this divergence between chaotic short-term liquidations and the slow-moving health of the network is the only way to accurately map the macroeconomic landscape for the coming week. To see how this divergence is playing out, we need a forensic breakdown of the week's trading carnage. This starts with the mechanics of a liquidity cluster. Those glowing yellow bands represent pools of extreme leverage. When the price moves into these zones, it acts like a magnet, triggering limit orders that force a cascading waterfall of market selling or buying. We saw this clearly on June 9th. The market aggressively wicked down, piercing deep into the $60,500 zone. As the price plunged, the bright yellow leverage clusters vanished. Those positions were absorbed and liquidated, clearing the path for the next move. Later in the week, we saw a violent snapback. Price rocketed vertically, slicing through the $63,000 and $64,000 levels. Surging into these upper bands forced short sellers to buy back positions at a loss, using their own liquidations to fuel the move. If you've managed to survive this week's extreme chop, drop a like on the video and let us know your strategy in the comments. This entire week was a zero-sum game of liquidity hunting. It was price action driven by the mechanics of leverage, completely detached from the fundamental realities of the Bitcoin network. To find the signal, we have to look away from the exchanges and focus on the base layer of the protocol itself. This is the Clark-Moody dashboard. The first warning sign is hashrate. Total computational power has dropped significantly to 889 exahashes per second. With miners off, blocks are found slower, so the network lowers the difficulty hurdle, creating this impending double-digit drop. For real-time alerts when these structural shifts hit the dashboard, make sure you're following us on Twitter. This drop in hash rate is connected to a massive contradiction in the fee market. Despite billions in trading volume on exchanges this week, the actual work happening on-chain is incredibly quiet. Look at the fee metrics. Median transaction fees are sitting at just 2 satoshis per virtual byte. Immediate clearance estimates are at rock bottom. This happens because the vast majority of the week's trading volume is occurring within the internal databases of centralized exchanges. Because these derivative clays never touch the blockchain, they don't contribute to the fee market, leaving the base layer starving for activity. This is a crisis for miners. They are trying to survive on a reduced block subsidy of just 3.13 Bitcoin, and with fees this low, they're earning a measly 0.03 Bitcoin in extra revenue per block. Subscribe for deeper analysis on these miner capitulation cycles to see who is surviving the halving. The network is quietly suffocating from a lack of genuine on-chain volume. This is forcing inefficient miners to unplug their rigs, which is the direct trigger for that massive 10.7% difficulty adjustment. By combining the liquidation data with the network stats, we can forecast the environment for the next 7 days. In the short term, price action is likely to stabilize. The most immediate pools of liquidity have been violently swept, and the market generally takes time to build up new clusters of leverage before the next move. On the network side, that difficulty drop will act as an algorithmic pressure release valve for the miners who stayed online. When difficulty drops by over 10%, it means the network requires significantly less computational work, and therefore less electricity to mine a block. By lowering the energy bill for every active machine, this adjustment effectively resets the baseline production cost of Bitcoin for the entire sector. The ultimate takeaway? Trading based on the flashing yellow bands of a heat map is a trap if you don't understand the underlying hash rate and production costs that dictate the real market. If you value high signal intelligence that cuts through the market noise, make sure to like, share, and subscribe. We'll see you in the next block.